I would say in my experience, the percentage of deals that aren't quite what we thought they were is close to 100%.
If you want to meet what your vision was, you actually have to do the work of integrating and moving forward with all those plans.
We make that mistake all the time in all the companies that I've been with. We think we understand because everybody operates like we do. Well, they don't.
Just because you can pick up 25,000 in some podunk town doesn't mean that that's going to be a growth engine for you.
Everybody's heard the saying, everyone has a plan until they get punched in the face, right?
That's right.
Plan on getting punched in the face with something.
I think the most important thing, and there's a lot, but the most important thing when you're transitioning a business is
Welcome to Coffee Break with Jake. I'm so glad that you're here. For those of you that may be new to the call, we host Coffee Break with Jake most Fridays at 11 a.m. Eastern. This call is also being recorded and is available in podcast form on all major podcast platforms and on YouTube. And you can read the monthly column in Security Sales and Integration. Want to thank you for being here. The purpose of this call is to bring together professionals from all over the industry to share best practices, to talk about challenges, to discuss opportunities, and really to understand how to best run your business as a security integrator. I have to admit, I selfishly host this call every week just for me because I've found that the most important things I know, I've learned from other people. And this has been a really great way for me to bring people much smarter than myself together to learn from them. I hope that you'll learn from them as well. Today, we're going to be talking about acquisitions and not just, sometimes on previous calls, we've talked about acquisitions once you get there. This is going to be more of a bigger picture look at acquisitions, everything from deciding that you're ready to pursue an acquisition to pursuing an acquisition and integrating that acquisition. And today's panel includes three of the smartest folks I know: Colby Monachino with Monachino Partners, a broker in the space, Sean Forrest, and Jennifer Holloway, our banker with CIBC US. And so before we get started in kind of some of the Q&A here, guys, if you would you introduce yourself, tell us where you're calling in from, and maybe just kind of a quick overview on your experience working in the security industry. I'm going to start with Jennifer.
All right. Happy to be here. Thanks for the invite. I have been lending money to the security industry for 31 years, and through a finance company, and then through working for operating companies, including Protection One, where I did M&A for 3 years before joining CIBC Bank to lend to the security industry at a banking level, and I've been there for 15 years now. So I currently sit in Dallas, which is my home base. I pretend to be in Chicago, which is the bank's home base. But I could not be more grateful for my experience in the security space. I've been able to build my career around this industry, and just grateful for it, and would just like to give back and talking to customers and prospects even before there is a need, or even though I may never be able to bank them, just helping them move their business forward is an important aspect of what I like to do to give back to the space. So thanks for inviting me.
Thank you so much for being here, Jennifer. And we'll go to Sean. Mr. Sean, tell us a little bit about your background.
Thanks, Jake. I'm a big fan of Jake as a businessman and of the coffee break. It's a permanent part of my weekly schedule because I always learn something interesting on the call, and I hope that's the same for everybody today. I'm president of Alarm Detection Systems. We're headquartered in Aurora, Illinois, in suburban Chicago. Large presence also in the greater Denver area. We're $4.2 million of RMR, mostly commercial, and we're a family-owned business, continuing to be owned by the founding family, now beginning our 59th year. And my background is it was really varied in the security business over 30 years. I started as a lender, starting especially lending groups at what was LaSalle Bank, became Bank of America, and then later Private Bank, which became CIBC. I left to go back into an operating role, and Jennifer actually took my place at the private bank alongside Mark Melendez. So I've been involved as a CFO and CEO in lots of different businesses, mostly private equity backed, heavy M&A experience as a buyer, a seller, and a lender.
Awesome. Thank you so much for being here, Sean. And Colby Monachino.
Yeah, thanks, Jake, and thanks for having me today. Colby Monachino, I'm the co-founder of Monachino Partners, based here in Columbus, Ohio. I have my younger brother too on the call, just to briefly introduce him. Joe Monachino, he's partner in crime. Monachino Partners provides buy-side and sell-side brokerage and consulting services to companies in the security, fire, life safety industries. We also stretch, a little bit into electrical and HVAC as well. And I actually got my start working under Sean at Alarm Connections. Prior to that, I entered into the government relations politics space in the trade association world, and did grassroots advocacy and lobbying. And I had a couple different positions at a company called NFIB. I worked in the field. I traveled a lot and worked with and helped small businesses, grow and develop their operations. I quickly learned, I think I was passionate about politics, but it wasn't a career for me. And at the time, Joe and Sean were, sort of changing and rebranding Alarm Funding Associates to Alarm Connections, and they had a central region relationship management role open at the company. And I dove in headfirst to that. I managed the central United States for Alarm Connections, so my territory covered pretty much from Michigan down to Texas, and then spread out, west a little bit into Colorado towards the end. But it was a great way to get into the space. I had a business development role as well as operational management role. Territory had around just $650,000 of RMR, number of different types of alarm companies that I worked with. Spent a lot of time on the road, and was a really great way to enter the space. That company merged with Alert 360 in 24. And I've always had an entrepreneurial kick to myself, and that's how Joe and I started Monachino Partners. So Jake, thanks again, and happy to be here.
Awesome, great. And again, for those of you that are just signing on, we're going to be talking about acquisitions here, big picture, everything from interest in acquisitions to preparing for it, to financing it, to getting to the closing table, and then integrating it. And I guess I'm going to have to go. I've got a lot to cover here today, so we're gonna have to get through these Q&As as quick as I can. Don't worry, to my panelists, I'll kind of keep things going so that we can cover as much of this as we possibly can today. But we're going to be talking about everything from the broker's perspective, the banker's perspective, and the operator's perspective. I think that's important for you to get a complete picture of what we're talking about when we're talking about M&A. And so first of all, I'd like to start with you, Sean. In your either at alarm detection or in previous roles, what's the reason that the companies that you've been a part of, what's the reason that they decided to pursue acquisitions instead of just purely focusing on organic growth?
Yeah, good question, Jake. It's really to supplement organic growth. So for many of the businesses I've been with, M&A is always a central part of a private equity strategy. In my role at alarm detection, we're not growing as fast as we would like to organically, and are looking for acquisitions that would increase our market share. So a good reason for anybody to look at an acquisition is there a way to increase your market density or market share? Is there a local competitor that might be ready to retire? Those are always really good acquisitions to pursue, because they're accretive in terms of folding them in. They're usually easier to integrate, more well known, because they're long-term relationships. Some of the other reasons, I've pursued acquisitions in the past was to pick up some expertise that we didn't have in-house. A lot of companies now are trying to figure out the best way to approach things like video monitoring, and some of those have been accomplished either by making acquisitions that included people that knew how to do it, or companies that specialized in it to fold in. So, and then the third reason to do it would be to expand market share. It's hard to start greenfield in a new city or a new area if you can start with an acquisition that gives some service density and personnel density, so you can continue to provide service at the level that the customers expect. Then that's a good way to jumpstart a new area.
That is a really great answer. So when we talk about, you're looking to pursue these acquisitions, Sean, before you did it, what did you need to make sure, what kind of operational capabilities did these companies need to make sure that they had to make sure that they were prepared to make an acquisition?
Acquisitions, I'm pro acquisition, but I would also say that no acquisition is easy. What it takes to be ready is your own house has to be in order, and that's look at it like you're buying your own business, and do your financials make sense? Do you know where you're making money? Are your people ready for the complexities of an acquisition? Do you have everything set up? And you can acquire good people in an acquisition that supplement the management team, but I think the first step is having your own house in order, and the second thing is doing it for the right reason. Some companies who have gotten in trouble with acquisitions have done it for growth's sake, growth for growth's sake, rather than a strategic reason to do it. So it doesn't make sense for my company to buy this other company. It would be great to grow by $50,000 of RMR, but it doesn't really make sense in the operation.
That's awesome. And so Colby, when we're talking about motivations, Sean he talked about, looking at achieving growth targets that exceed what's available organically, talked about bringing in some additional talent and maybe being able to bolt on new types of business and categories. We've seen that. In fact, I was just talking to John Perry with Sting Alarm on a previous call, and John had acquired a fire alarm company that helped them get into the fire alarm space, and that's been very successful for them. But could you maybe talk about some of the motivations you hear from buyers? Does that align with what you're hearing, and are there any other reasons that folks might be looking to pursue acquisitions?
It definitely aligns. I think if you look at it in today's market perspective, I don't think it's new news to a lot of people that consolidation has been and acquisitions have been active over the last 2 years, if not more, in our industry. So I think that all aligns for sure. And for those looking to get into the acquisition space or actively acquiring, I think, to echo Sean's point, but when done correctly, it can definitely accelerate growth and create opportunities that you may not be able to organically. But, I think in addition to that, it allows you as a business to stay competitive and, get, even in some capacities, get ahead of your competition. And John's case, it helped him get into the fire alarm space. We've worked with companies that it allows them to expand their fire service capabilities as a whole. Sometimes it's looking at what services do I offer and what opportunity is accretive enough to my business where, if acquired, it kind of takes me to that next level.
Awesome. And so Jennifer, if there's folks in the call here that are thinking about maybe, pursuing acquisitions as a part of their growth strategy, at what point should they begin preparing financially to make this a part of their strategy? How far in advance of pursuing their first deal should they be talking to their bank and maybe kind of, getting everything lined up?
I think I would start with the market today for acquisitions in, our client base, as an example, is very strong. There's still lots of acquisitions being done. They're not all being gobbled up by private equity. There are still opportunities there. They may not be the biggest of the ones that go out to market, but there are still deals to be done. And in those cases, most of our lines of credit that we have in place with our client base, I would say the majority of them are used for acquisition financing. These are companies that are cash flowing, they're covering their own organic growth, and they borrow when they want to acquire. Then they sort of aggressively pay those loans down with their accretive cash flow that's coming off of that acquisition, right? Which is one of the things that you should be looking for when you acquire something. Is it going to create some cash flow? And they're paying it down so that they'll be in a good position to make the next acquisition, right? They're sort of just, putting more dry powder away for the next one. So as far as when, have a strategy, understand what it is. If you're in Texas and you want to go to Oklahoma or Louisiana, have a strategy, understand the market. If you buy in a tertiary market, like a secondary market, there might not be the growth potential that you have in Dallas, right? Or Plano, some bigger metropolitan areas. So do your homework and understand sort of, just because you can pick up 25,000 in some podunk town doesn't mean that that's going to be a growth engine for you. So have a strategy and then try to fill your strategy. Have a little checkbox on, does this meet with what I want to accomplish for the company? Otherwise, you'll end up with cats and dog accounts all over the U.S.
I'm going to make sure that's included in the write-up, Jennifer, to avoid buying cats and dogs in podunk towns. Quote Jennifer Holloway,
right.
CIBC Bank. I love
My
it.
job
I
is
love
done
it.
here.
So Jennifer, talk to us, while we're talking about, preparing and financing, what type of financing, and you talked a little bit about lines of credit, but help us understand what type of financing options are available to security industry buyers today.
RMR lending is a specialty lending. It's like Jim Wooster, who I know is a previous guest, has a great lending program based on RMR. There's a few banks in the space like CIBC that lend against RMR. Going to your local bank and showing them your balance sheet and your income statement is not going to warm their heart, because the value of their RMR, their most valuable asset, isn't even on the balance sheet. And typically a fast growing company is spending down their EBITDA to create new RMR. And so those two things together, a banker who's not familiar with the industry will not understand that your RMR is worth 40, 45, 50 times, but it just doesn't show up on the balance sheet. That's not going to work out. So RMR financing is one way. I've seen sort of an initial platform acquisition get really creative, and they're using their house, their personal equity to make that sort of first platform acquisition, because they feel so committed to it. The RMR itself has a value, and most banks that are in this space will loan at a percentage, like loan to value, right? And that percentage, let's just say, is 50%. So you can get a range of advanced multiples on that RMR, say 20, 24 times RMR, because the market for your business is maybe 40 to 50 times. And so that's how the bank gets comfortable. Now, we all know that not all RMR is created equal. This is based on good contracts, good margin on that monitoring contract, good attrition, really great attrition, and cash flow. If you are doing something different than those things, you're probably not going to get those top multiples.
I think there's a lot to unpack there with RMR. It's not, $50 in RMR is not $50 in RMR. And we see this kind of across the board. I don't want to dig too deep into this, but I just want to Maybe if you could give us a number on this, Jennifer, what do you typically see as a percentage of a margin percentage on gross RMR? Is there something that is kind of a sweet spot for you guys?
On the monitoring margin, not uncommon to see north of 80%. And really depending on the type of business it is, some of my really the highest margin accounts I have, they usually have wholesale monitoring. They're wholesaling their monitoring with someone else. Those margins can, get up in the 90, which is amazing, right? And then we also look at the monitoring and service, because in some cases that monitoring contract covers some level of service or maintenance, right? So you might not be able to charge labor and equipment if you have to go out and change out a panel. So we also look at the monitoring margin and the monitoring and service margin together. So the monitoring margin, we expect to see, north of 80, and on a monitoring and service margin, sort of north of 70, 75.
Sean, in pursuing acquisitions, how have you historically looked at cash versus bank financing versus seller financing? Have you kind of evaluated in different deals whether you wanted to use cash or bank financing, and have you ever seen seller financing?
Yeah, good question. The companies I've been with have been primarily private equity owned, which means leveraged, lots of debt. So I would say all of the acquisitions that we did during those periods were financed. Alarm detection's in a different situation, cash rich. We don't have any debt. We're pursuing acquisitions, trying to ramp those up as a way to invest the excess cash into something more productive and has a great return, and RMR does. So our situations have been different, but I think the important thing to consider when you're considering your funding is not putting too much stress on the business. And Jennifer or one of the other lenders she mentioned might lend you 24 times RMR, but what does your cash flow look like to service that debt and eventually pay it down? And keeping the business in a point that doesn't put it in distress is a really important factor to consider when you're thinking about the funding. And then a seller financing, some of the seller financing that gets done is in the form of either a holdback or an earnout or something like that, and those can work out really well for the seller, depending on the seller's situation. So some of the sellers are looking for an exit, but not necessarily looking for all the cash on day one, and there are tax advantages for the seller to finance the deal. It also helps them sell something to someone they really want to be the buyer, whether that's an employee or next generation or a neighboring company. It's usually driven by a strong relationship between buyer and seller, and that maybe lack of need for all the immediate cash.
That's great. And Colby, as you're working with and advising sellers, how do you help them evaluate deals based on how it's going to be paid, whether that's through an all cash deal, some form of holdback or earnout? What guidance do you typically offer sellers in these various scenarios?
If I can just back up quickly, just on a point Sean made on seller financing, and can answer the next question. But from a buy side perspective on seller financing, Joe and I have been involved on deals where it's either somebody acquiring for the first time and they need to incorporate some sense of seller financing just because they don't have the cash to acquire the entire business. They don't want to get a loan, etc. Tale of caution for buyers is it's maybe a good strategy depending on the deal, but just get an understanding of some of the legal ramifications or legalities that can come up tied to seller financing. If it's an asset deal versus a stock deal, where are those funds and proceeds paid out to over time? In addition to that, what can you hold a seller liable? What can they be liable to and what can they not be liable to if you're incorporating seller financing? So just an added point to it. I think, we run into it a lot of times where people want to sell or owner finance it, and you just want to be cautious with the approach. And then to answer your question is, when we're working with clients, what Joe and I ultimately like to do is evaluate the opportunity holistically. So, if we're working with a seller, we do a full comprehensive analysis of the business, breaking out their entire revenue profile, RMR, their transition plan and focus, marketplace, and really use that information to determine the best value approach that we would ultimately take to market that the buyer is comfortable with. And I think from the buyer's lens, you need to evaluate the opportunity in the same way holistically. What does the revenue profile look like? What am I acquiring? Am I acquiring accounts? Am I acquiring a company? If it's a company, what type of company is it? Is it a company with a lot of diversified revenue, or is it more of a traditional RMR heavy type business? And from there, once you find out the answers to that, you can kind of figure out your valuation approach. And from there, how are you going to acquire it, and how are you going to acquire and integrate it into your business?
Colby, you talk about, really looking at what type of business it is, right? Whether it's more weighted with RMR. Talk to us about how two similar companies, that you're looking at might receive dramatically different valuations, where one might be, really like maybe like a darling type company, and one is like, hey, I don't know about this one, right? And what can cause those dramatic differences in valuations with otherwise seemingly similar businesses?
There's a couple different factors that play into that. We said this at the beginning of the call, every acquisition's a little bit different. They have their own intricacies. So from the buyer's lens, from a value perspective, it could come down to what are you looking to buy? What, like to Jennifer's point, if within your acquisition strategy, there could be two similar companies, but in two different marketplaces. That can play an impact into value on the business. And I think additionally, what we're seeing is if you look at it from a high level traditional RMR perspective, you could have a business with similar RMR. It's maybe, for example, maybe majority commercial. But then when you dive into the details, the revenue breakouts on both businesses could be a lot different. One has traditional, predictable, contracted RMR, but it's also has, contracted or solid service revenue adding to the bottom line. Maybe a company similar to Sean's, I know he just rolled it out, but companies recently rolled out video monitoring, another service revenue line added to the bottom line. And on the other hand, the other company is a great company, low attrition, ran well. It's just a little bit more traditional, heavy RMR based. And then when you get to the bottom line, you're really looking at two different types of net incomes. Yeah, I think you really have to look, the devil's in the details in a lot of this, but it's just coming down to evaluating the opportunity. And from that, you're going to see two different valuations.
Awesome. And Sean, as you're looking at target companies, what are some red flags? What are some things that really stand out and maybe give you some pause as you're looking at potential acquisition opportunities?
Yeah, Jake, I would say sort of the early deal killers are contracts. There are still a lot of companies in our industry, unfortunately, that believe in the handshake. The handshake's great as long as there's also a contract. Contracts are needed to protect the alarm company. So we don't do anything without a contract. I know the lenders are similar. If you ever expect to borrow money, have contracts. So we do that really early on to make sure that we're satisfied with the contract. And we run into a lot of opportunities where the contracts just aren't up to snuff with us. They don't have limits of liability. They don't have the right contract terms. They have an assignability issue. And often we'll go back to the seller and say, if you can clean these up, we'll take another look. But that's a big one. But once we get beyond that, we're looking for the sustainability of the cash flow that we're acquiring. So, how strong are the margins? How strong is the cash flow? Do we expect it to grow or shrink? Is it just a group of accounts that will trade off, or is it a market that should grow? And then how long do we expect that cash flow to last, which is the attrition rate? So we're looking for businesses that have great relationships with their customers, as evidenced by low attrition. And then the other red flags would be concentration in the business. If one or two customers make up a bulk of the business, that's risky. So we'll take a hard look at that. And similarly, when we're acquiring a small business, we have to look at the owner risk. So the concentration of the relationship with the existing owner or a key employee. And if it's the owner, you can do that through the contract. If it's a key employee who has all the relationships, then that's a trickier contracting situation to make sure that those relationships will stay and not be pirated away if that key employee doesn't like the deal that the seller made.
Yeah, I know I think there's a lot of cautionary tales out there of scenarios. I think that if I polled 1,000 alarm dealers, many of them might feel a little bit guilty if I asked them how many of their former employers' accounts they signed up the first year when they started their own business. Because gosh, I've heard so many startup stories that sound a lot like stealing stories more than startup stories. Jennifer, talk to me a little bit real quick, if you would. One of your clients maybe has identified an opportunity, but what is something that makes you guys as the banker pump the brakes? And if there is a specific scenario you could describe to us that you guys had to just kind of walk away from.
Yeah, with our clients, in our relationship with our clients, the call comes in very early. The LOI is they're working on the LOI. They've seen enough of it to issue an LOI. And so the call comes in early where they're describing it to us and we're suggesting any supplements to their due diligence plan. Oh, great, they're this and that. Well, have you considered if you're going to do X, Y, and Z? What about licensing? Because you don't have that and the seller does, and he's not going to be with the business anymore. How are you going to retain that? So we sort of knock out some of those things in early calls so that when they're issuing the LOI, even sight unseen, they can sort of feel good about if it all gets confirmed in due diligence, there's likely a deal here. If they're interested in doing something that is just very different, we would have that conversation early. And I'll just make an extreme example. A security company, but has this great opportunity to get into the car wash business, right? But it doesn't jive. It's not what our use of our revolving line of credit is made for. It's to grow the security company. So that's a non-starter. But some of these other, services might not be a great fit. And we just talk those things out so that you're never getting to the point where full on running to the goal line and then their bank's throwing a flag saying, nope, that's not going to work for us. Because we have those cash flow conversations, we have those margin conversations, we ask for copies, sample copies of the contract. Just like Sean said, that's a good first test. How do they run their business? Are they able to come up with financial statements?
Let's say you've identified an opportunity, Colby. You've met with the seller. You've had that, really great dinner meeting. Everybody loves each other. We're going to do a deal. What should buyers focus on when drafting an LOI?
The first approach you need to take is, the structure of the deal. So what valuation approach are you going to take? So going back to my previous comments, is it going to be a RMR deal or is it going to be an EBITDA deal? Assuming you've done your pre-diligence, you structure your LOI around incorporating what the owner or ownership's plan is going to look like. mainly because that ties into the valuation. As you dive into specifics of value, there's transition plans, there's potential rollover equity, there's opportunities for ownership to stay on and help transition the business or stay on full time. So I think it's defining the value structure that will take place, and then after you work through due diligence. The other thing I would advise on, and Joe and I tell everybody this, is he and I on our end, we're not attorneys, so it's important to have a good relationship with, in these cases, a good industry attorney, and there's a number of them, because you want to make sure that your LOI is structured to whichever party, seller or buyer, but you want to be sure that the LOI is structured correctly legally as well, and that you're protected, whichever side you may be on.
At the point of an LOI, you know what the buyer's base or the seller's basically told you, right? But you haven't really gotten an in-depth look under the hood. How often do you find that what was the original picture does not line up with what's actually going on? And how do you navigate that, right? Like, how do you have a seller that thinks that their business is worth this. They think that their metrics are, really terrific. But then you start looking at it and you say, hey, there's some things here that, they're not as you described them, right? Like there's a lot of, maybe there's no maintenance agreement, RMR, but you're providing a tremendous amount of free service to customers. And when we look at that, there's a real cost associated with it. How do you navigate those kind of difficult conversations to bring a seller back down to reality and to a realistic valuation when that does come up in due diligence?
Yeah, it's a good question. And I think that what you just laid out is it is a common deal killer is, during due diligence, when you're validating earnings and what they are projecting, the number they're asking for cannot be confirmed. It's common across the board. And I think one way to work through it, and what Joe and I have found the best ways to help our clients work through those types of situations. And I think this is a common theme throughout our industry, but you should do this before you get into due diligence, but develop a good relationship with the seller and their representatives as well. In every deal, something comes up, and in some deals, more things come up than others. It would be great if things worked perfectly smooth, but you're integrating a new business under your platform, and questions come up. So developing a good relationship allows you to create a plan of action as you work through those things. We're working on a deal right now where we had we're representing the seller, and we're on a weekly diligence meeting, and some of the bill to addresses and the site addresses are not totally matching up for the buyer. That ties fully into how they're going to integrate it and then ultimately bill the customers. It's not a deal killer, but it needs cleanup. And what we have as a foundation in that deal is a good seller buyer relationship where we had a clean outcome and plan of action on how to tackle that to still work towards a close.
Jake, would you mind if I add a comment to that?
Please.
I would say in my experience, the percentage of deals that aren't quite what we thought they were is close to 100%. And that's either found before or after the transaction closes. And one of the reasons I know so much about M&A is because I've made a lot of mistakes in my career in acquisitions. But I think the point of is to try to figure it out before the deal closes. It's so much easier to deal with it then. But that requires some in-depth due diligence, asking lots of great questions, not assuming that the business is exactly like yours. We make that mistake all the time in all the companies that I've been with. We think we understand because everybody operates like we do. Well, they don't. And the other piece on due diligence is hire a professional to do the due diligence, regardless of how large or small it is. They will ask some of the things that maybe are harder for you to ask or you don't know to ask. And Joe and Colby do that, and a couple of other firms do that. But but hire a professional to do it. And then once you find something that's off, transparency in the conversation, it's starting to build that post acquisition relationship during the due diligence, and often the seller doesn't know the situation that you found, and they'd like to talk through it and talk through the alternatives.
Just kind of talking back to some of these challenges that might come up in due diligence, kind of post LOI. I had a conversation with a dealer yesterday that was working with a seller. They were looking to buy the accounts, but the seller didn't understand the unearned income component to contracts that they were billing annually. And I feel like this comes up a lot in my conversations with dealers. They think that their account is worth, or their accounts are worth a certain number. And for those that are listening on the call, what I'm referring to here is most often when you're billing customers annually, and there's a portion of there's a deduction made for unearned income. Sean, could you maybe help
Sure.
explain that for the
Yeah,
folks on the
I can
call?
help. So it's deferred revenue is usually the accounting term for it. At Alarm Connections, we call it pre-billed revenue, but the concept is that you already received the cash and the service is going to be followed in the future. So for the buyer, they've missed that cash payment, but they have all the expense that will come with providing that service over a period of time. So that's the reason why it's deducted from the purchase price, because the seller's already received that cash for the year.
Yeah, and just for like a super extreme example, let's say that you bill your customers every 3 years. They pay for their monitoring, and gosh, God bless you. That's amazing business
That would be
model.
great.
Yeah. But let's say that were the case. And let's say that the value of your business was 36 times, revenue. You could not bill your 3 years of monitoring on January 1st, collect all of those payments through January and into early February, and at the end of February, sell your business for the 30s. Again, it's an extreme example, but just to illustrate it for the folks on the call, it's really the same if you bill annually. If you've collected 12 months in advance, that portion of prepaid service is going to be deducted from the purchase price. And you should know, if you're a buyer, to look for that, right? That's an important thing to consider.
Just to add one more thing here, if your seller is a smaller company, there's likely not going to be an entry on their balance sheet that says, hey, this is my deferred revenue. It's going to be when due diligence and you get the listing of your billed through date, and you do the math and go, billed through date, if I buy it on July 1, all this other has already been billed and collected. So especially if they're not GAAP, which is totally common from the seller side.
It's on that topic and it ties into, a couple other items, but, I would echo this for sellers. I would also echo it for buyers to get an understanding, but for sellers, deferred revenue is one of a couple different types of deductions or, effects on the purchase price. And my only piece of advice there is it can be a deal killer if you don't have an understanding of what deductions come out of the total or gross purchase price of an acquisition. Some can be surprising. That's a typical topic Joe and I kind of have to talk through early on in the process.
Let's say that you have navigated the minefield from LOI to the closing table. You guys are celebrating a successful transaction. Joe Monachino is adding another bottle to his tombstone collection, and everything is good. Sean, what happens after the deal closes that buyers underestimate?
The integration of the business is the difficult part of making an acquisition, and what buyers usually struggle with is they don't make a detailed plan of all the steps to really integrate the new acquisition, and that's contacting customers, that's making sure the billing goes out, converting into your own systems, or dealing with the IT issues, dealing with the IP of it, the phone numbers, websites, things like that. All of those things are really detailed items that are difficult to get your arms around. So building an integration plan that you can implement over and over is important. Again, some of the experts that are out there can really push that along and provide that checklist, which is helpful. And then and my advice on acquisitions and having made this mistake is to go as quickly as you think you can, and maybe a little quicker than that. The faster that you integrate, the better. There's no real benefit in waiting to be nice or to to do it slow so everybody gets used to it. None of that is real. It's
Yeah.
do it
I
fast.
wish you and I had this conversation a couple of years ago, Sean. I had done my first acquisition, and we stuck with two systems for like way too long. And I gotta tell you, I will never ever do that again. Like, prior to getting things, as soon as the deal is done, we're training everybody on the new system. We're implementing the new system, because I gotta tell you, it took probably a year off of my life, I think. Is I kind of look at stress as like how much time it's taken off. Probably about a year. All in all, worked out and was a very good learning experience. But I could tell you firsthand that is really, really solid advice on integration. Jennifer, I want to talk about post closing from a part of having a credit facility in place. You have loan covenants, right? And can you talk about what a borrower needs to consider as they're operating their business, just in general, and what some of those loan covenants might look like?
In our typical revolving line of credit, there's only a couple covenants, attrition being one of them. So the impact of attrition of that acquired account base on the portfolio would be sort of an important consideration. And then the second is a cash flow covenant. Is there enough cash flow coming off the business to cover the nut, pay the expenses, make the taxes, if there's a seller note, the principal and interest on the seller note, the interest on the revolver? Is there enough to cover that comfortably? Super important is the cash flow. And I would go back to when the buyer first got interested in this acquisition, he or she had grand plans, right? Oh, I can cut out these costs. I can transition so easily into this billing system and move the monitoring from here to here, and I'm going to save all this money, right? Well, follow that all the way through. Now you're at the closing dinner and you're working on your transition plan. You have to execute on all of those things from your grand vision at we had a great meeting initially. From that vision, you have to execute on those to actually get the savings. If you're looking at that account base and saying, I offer fire and I'm acquiring this security only business, and I'm going to go into those commercial clients and I'm going to sell them my fire services, I'm going to expand. Look at all the great things I can do, offer to this base that I just acquired. And I'm going to increase their RMR and all those things are part of the implementation strategy. If you want to meet what your vision was, you actually have to do the work of integrating and moving forward with all those plans.
Yeah, no, I think that's whether you're pursuing an acquisition or not. I think there's really just solid advice in that, right? Like when you put together your master plan, your plan for success, you got to do those things, right? Like those are the things that are going to get you there. Colby, looking back on transactions that you've advised on, what mistakes would you say that some buyers have made in the first 90 days?
I think the most important thing, and there's a lot, but the most important thing when you're transitioning a business is preserving the customer experience. You don't want it, you want to try to prevent as much disruption to that as possible. And then, complemented by that is, converting billing accurately as well. So, I think having a strong plan in terms of how that will be executed and what members, whether it's an advisor or members on your team, are going to be taking lead on that process. We've seen where that was messed up or not necessarily handled a 10 out of 10. And then all of a sudden your customer care team's dealing with angry customers that are confused. You want, clarity, transparency, and everything to move smoothly.
Everybody's heard the saying, everyone has a plan until they get punched in the face, right?
That's right.
Plan on getting punched in the face with something. You're going to get punched in the face, and really, the more focused you are on implementing your plan, the less that's going to derail, the deal post acquisition. Guys, I want to kind of go to some lightning round questions here because we're coming up on time. Colby, typical deal. How long does it take from initial conversation to completing the transaction?
So initial conversations can take maybe up to a month from introduction to potentially meeting and evaluating the opportunity. Again, every deal is a little bit different. I would say, post LOI, you're looking at about, 3 months, if not a little bit more on due diligence. You want to move smoothly but accurately. And then typically it's about, 90-day to a year, depending on the size of the transaction, post acquisition integration.
Awesome. And Jennifer, what's the most important thing a buyer can do before approaching a lender?
Know their numbers, just have their financials ready. It's the first thing I'm going to ask for is, hey, can you send me your company prepared financials for last year and year to date this year and your roll forward? First question.
Awesome.
And if it takes you 6 months to deliver it, that's a flag for me.
Sean, what do you know today that you wish you knew before your first acquisition?
Great question. I know the best route is to work with people that already know what they're doing. There's no need to invent the wheel. There are professionals and I'm talking about bankers, brokers, consultants. There are people that know the road, and hire them, work with them, and they will guide you.
I want to thank you. My esteemed panel, for being here today. For the folks listening, acquisitions can be one of the fastest ways to grow a security business, but they require preparation, discipline, and the right team around you. I want to thank Colby Monachino, Jennifer Holloway, and Sean Forrest for sharing their experience with us today. I also want to thank all of you for tuning in to Coffee Break with Jake. I especially want to thank those of you that do business with us today. I appreciate the opportunity to serve you as your distributor of choice. If you don't do business with us, I encourage you to reach out. I'd love to talk to you and see how we can help you grow your business and print your logo on the products that you install. But whether you do business with us or not, I want to thank you for being here. You are always welcome on Coffee Break with Jake, and I hope you all have a great weekend.